Welcome to The Explainer. Today, we're diving into a company called Simplify that's trying to tackle two of the biggest puzzles for investors right now: how to find steady income and how to get into Bitcoin without all the hassle. But here's the catch. Their solution uses some seriously complex financial tools. So the big question is, does the name Simplify really fit? Let's unpack it.
So if you're an investor, chances are you've thought about these things. Are you trying to squeeze out a better income stream in this kind of market? Or maybe you've been watching Bitcoin and you're curious, but let's be honest, the idea of setting up a crypto wallet feels like a huge pain. Well, these are exactly the challenges that Simplify says they have an answer for.
Now, their approach is definitely not your standard portfolio of stocks and bonds. They use this really powerful and really complex strategy called the derivative overlay. To get what these ETFs are actually doing, we first have to understand the sophisticated ingredients they're made of. So, what in the world is a derivative? Well, think of it this way. It's a financial contract that gets its value from something else. So, instead of, say, buying a share of Apple stock, these funds use contracts that are based on the movement of Apple's stock price. You're basically investing in the behavior of an asset, not the asset itself. And one of the key derivatives they use is called an option. The crucial thing to get about an option is that it gives you the right to do something, but not the obligation. You have the right to buy or sell an asset at a price you've already agreed on. That flexibility is what lets these funds build some incredibly specific and pretty powerful strategies. And that right there brings us to the main event, the option overlay. What Simplify does is they take a core portfolio and then they literally overlay it with all these different option strategies. And the goal is usually one of two things: either generate some extra income on top or protect the portfolio from any big, scary market swings. Let's see how this actually works in practice.
All right, first up, let's talk about the hunt for income. We all know finding a decent, steady cash flow from your investments can be really tough these days. So here's how Simplify uses its toolkit to try and solve that problem.
So if you look at funds like HIY and SUBR, their main goal is to deliver income. And they do it using what they call an income-generating option strategy. Now, what does that really mean? Well, in plain English, it means they are constantly selling options contracts to other people in the market. And every time they sell one, they collect a little bit of cash. Here's how the process basically works. Step 1, the fund sells an option. And right away, it gets paid a cash fee, which is called a premium. Step 2, they just wait. Time passes. And then step 3, if the market moves the way they expect it to, that option just expires without ever being used. It becomes worthless. And when that happens, the fund gets to keep that entire cash premium as income. And they just do this over and over and over again to try and create a steady stream of cash.
Okay, let's switch gears to strategy number 2, getting access to Bitcoin. A lot of people want a piece of the crypto action, but honestly, managing digital wallets and worrying about private keys, it can be a real headache. Simplify offers a different way in. So instead of you having to go out and buy Bitcoin yourself, funds like Maxi, that's the Bitcoin Strategy plus Income ETF, and SPBC, the U.S. Equity plus Bitcoin Strategy ETF, they get you that exposure indirectly. They invest in other financial products that are designed to track Bitcoin's price. So you get to sidestep all that direct ownership stuff. And these two funds go about it in really different ways. Maxi, for instance, is all in on derivatives. It's using futures, swaps, and options to get that Bitcoin exposure. It even, get this, uses a wholly owned subsidiary based in the Cayman Islands to do it. SPBC, on the other hand, is more of a hybrid. It's mostly a portfolio of plain old US stocks, but then it carves out a small slice, about 10%, to invest in other Bitcoin ETFs.
Now, this slide makes a really critical point. Just because you don't own the Bitcoin directly doesn't mean you get to escape its insane volatility. Just look at the returns for SPBC, down almost 28% in 2022. Then, the very next year, it's up almost 49%. Those are some seriously wild swings. It just proves that the risk is still very much attached to the investment.
Okay, so these strategies are, without a doubt, pretty clever. They offer some really creative ways to approach some common investing goals. But this kind of financial engineering does not come for free. The price you pay for all this sophistication is complexity. And with complexity comes a whole different universe of risks. And this is probably the most important thing to understand, we are not in the world of simple, boring index funds anymore. The legal documents for these ETFs, their prospectuses, they're crystal clear that these products involve risks that are both way higher and just fundamentally different from what most of us are used to.
This quote here is taken word for word from Simplify's own legal filings, and honestly, it should give you pause. The potential loss from written options could be unlimited. Just let that sink in for a second. Unlimited. When a fund sells an option to get that little bit of income, it's not just collecting cash, it's taking on an obligation. And if the market makes a huge move against them, the losses aren't capped. They could, in theory, just keep growing and growing.
And that's just one piece of the puzzle. The list of risks goes on. The options themselves are officially described as speculative. We all know Bitcoin is new and incredibly volatile. Using derivatives introduces something called leverage, which is like a double-edged sword that magnifies both your wins and your losses. And finally, you have what's called active management risk, which is just a fancy way of saying that this entire complex strategy might just not work.
So where does all of this leave us? We've seen how Simplify uses these really sophisticated tools to try and create higher income and give people easier access to Bitcoin. But we've also seen the very real, very serious warnings that come along for the ride. And at the end of the day, this is the question that every single person has to answer for themselves. These derivative overlays, they open up a whole new playbook of investment strategies, but they are operating right on the cutting edge of financial risk. The most important thing is to truly understand that trade-off before you even think about jumping in. Does the promise of a simpler solution really justify the deep, deep complexity that's running just under the hood?